Okay, Merry Christmas, everybody. Technical difficulties right out of the gate, so that's pretty typical here. But I'm back in Dubai, so this is the first stream from this Airbnb. It's a little bit sketchy. I would just ask you to bear with me if it's flickering, if it cuts out. I think we're going to be okay, but this is the best I could do. I tried to do a little bit of a Christmas set for everybody. No tree, but Dubai, there's actually some trees out there if you're out walking at the malls and stuff. Little bit surprised this year. There's actually kind of a Christmas vibe to the whole thing, but there won't be much else for me here. So welcome everybody. Hope it was a fantastic year for you. There's a few days left, of course, but hopefully 2023 treated you all very well. I'll be doing another live stream next week. Talk about some goal setting, talk about how we can maybe, get this volatility trading to 2024 being an even better year than it was this year. So I do know that, of course, the community did well, the VTS community, but also I do hear from people outside the community. And I think it was a relatively successful year for quite a few people. I hope anyway. That was the feedback that I was getting. So thank you all for joining. There's quite a few questions coming in. Let me just glance, see if anybody's screaming at me that there's a problem. Sound, video, I think we are good to go. So, yeah, let's get right into it. Give it a like, especially since it's Christmas. My live streams are always free. Don't super chat, don't send any money. You can ask any questions you like, but definitely give the live stream a thumbs up if you would be so kind. That's always the best way to boost the YouTube algorithm. So let's get right into the first segment. Yes, somebody mentioned there was a little bit of a problem with the audio. So I've clicked off the echo cancellation. Hopefully that fixes everything. So essentially what we're going to be talking about today, the good old volatility ETPs. When people look at these charts, I'll pull up the VXX. Everybody will kind of get the idea. When people look at these charts, of course, the natural inclination is for people to just say, oh, wow, this thing definitely goes down long term. Let's just short the thing. Well, there's a few problems with that, of course. And I'm an options trader, pretty active options trader. And there's a lot of strategies that you can use in the options world to mitigate a lot of the risk involved. But even within the volatility ETP space, there are also other ETFs to choose from. So that's kind of what we're going to be talking about today. But obviously quite diabolical. Now, if you're just looking at these numbers, of course, it never actually hit 6 million as a price. This is a split adjusted price. So when you retroactively put things backwards, of course, the splits continue to add to that value. And it looks especially ridiculous when you look at the UVXY. This is a 1.5 times leveraged product. You can see it never actually traded at 64 million. That's just a simulation back to 2004. When you have so many reverse splits in a product like this, you can see the VXX over here. Every time it does it, you basically multiply by 4 and it compounds backwards. UVXY, sometimes it's a 1 to 10 split. So the prices can be pretty obscene, but I assure you that they were basically, right around the $100 mark when they launched, and they bounce around back and forth. But yes, the UVXY split adjusted did actually go from 64 billion down to about $10 now. So when people see this, what's the natural reaction? Well, we need to short this thing. So that's what we're going to talk about today. Now, first of all, we have to kind of paint the picture of our current volatility landscape. Now, there was a time not too long ago, back before February 5th, 2018, when there were dozens of volatility ETPs. New ones were launching every month, it seemed. But these days, we are actually down to what I would say is a pretty reasonable level of volatility ETPs. So this is just a little mock-up of the VIX futures term structure. Of course, I'm sure you're all familiar with VIX Central. That's all that these are. This is just freely traded VIX futures, and this is very relevant to volatility ETPs, of course, as I'll talk about in a second. But if we look at the volatility landscape right here, the first group that I would classify as, we've got the long ETPs that trade the front 2-month VIX futures. So remember, volatility ETPs, and this is kind of a confusing subject for a lot of people, but volatility ETPs don't really have any supply and demand dynamics. There's no buying or selling that's causing these ETFs to go up and down. What it is essentially a formula, so to speak. It's a methodology of they hold the front 2-month VIX futures. Depending on how many days to expiration, they'll be holding a weighted combination of the front and the second month. And those futures, the movement of the value of those futures is what's causing the price movement. So you can actually see all of the volatility ETPs actually trade based on underlying indexes. So the VXX, for example, this is basically the longest running, the OG of the volatility space, launched in January 2009. The underlying index is the SPVIX STR index. So what this index is tracking is simply that, the front 2 months of the VIX futures. So this is one of the reasons why doing technical analysis, for example, on the VXX doesn't make any sense. So when you see people on Twitter and they got their VXX chart or their UVXY chart, they're talking about resistance and support and, oh, it's going to cross over this and whatever, flag patterns. None of that makes any sense. Of course, these volatility ETPs have no supply and demand dynamics. If you wanted to do your technical analysis on the front 2-month VIX futures, I mean, be my guest, but certainly doing it on the ETFs themselves makes no logical sense. Kind of the same thing with the VIX index, right? You see people do their technical analysis on the VIX index, kind of nonsensical. The VIX is just a statistic derived from S&P 500 options activity. It's a non-tradable product. There is no supply and demand. There is no price action. So people doing technical analysis on something seems a little bit ridiculous to me. But if you want to do TA on the S&P 500 options market, okay, you know, that might be fairly involved with all the strikes, but go for it. Anyway, neither here nor there. These things do track underlying indexes. So for example, the SVXY, it has its own. This one is called the SPVX SPIT. I know these names are kind of confusing, but I'm just kind of illustrating that they all trade based on underlying indexes. The new SVIX and UVIX, for example, they trade based on the short vol and the long vol indexes. You get the point. These are essentially just formulas. So we've got the front 2-month products, which there's 3 of them currently that I would say are tradable. I would probably ignore the 2 times. It's just too much action, too much leverage. You'll probably get yourself into trouble. There's no reason to take on leverage that much. But VXX is a good product, and there's lots of practical uses for it. UVXY is very popular as well. But these are our long products. So when you buy these, if you buy this ETF, ETN in the case of VXX, if you buy them long, you are essentially long volatility. So if you wanted to do the short vol trade, which probably about 70 to 80% of the time you should be short vol, you're going to have to short those directly. So there's some complications with that we'll get into later, but there's also a long volatility that plays further out on the VIX futures curve, M4 to M7, exactly the same sort of structural methodology where it's rolling the VIX futures. This is not a supply and demand product either. It has an underlying index. But you get the point. There's 4 long vol products. Then we've got these short vol products. And when you buy these ones, if you go out and you purchase the SVXY, which is 0.5 leverage, or the SVIX at 1 times, these are inverse products. So you are directly short volatility if you buy these on the long side. You can understand that there are some practical benefits to doing that. You're not actually shorting anything. You are buying an ETF that is pre-packaged at an inverse daily of the VIX futures. So that's quite useful. And then, of course, there's a midterm futures product as well. This is kind of new. It's based on an old one that was called ZIVB. That one traded from 2011 all the way up until 2020. And now it's kind of resurfaced here. So this is our volatility landscape. Now, I would say that you want to stick to these ones. There are other ones. For example, VIXY, just as good as VXX. There's no reason I didn't list it here, to be honest. I just wanted to keep it simple. And there's a VXZ product here as well. But anything outside of that, I would consider, you know, volumes low. The products are probably those dynamic types that they try to do their own side hedging. I like to be my own risk manager, so I do actually stick to just these pure products. But that's our volatility landscape. So what we essentially want to do now is, because we've had actually a really good short volatility signal, that, my strategy picked up on pretty early on November 1st. Hopefully yours did as well. It's been a good solid 2 months where we've been short vol with no interruption. We've just got the position and held it. I can actually even show you that in where's my strategy here? So I'm not going to show you the whole thing. This spreadsheet is pretty massive, but you can see that, we were in safety at the end of October. And then November 1st, we caught the short vol signal. In our case, we actually, when we are shorting volatility within our strategy, 20% of our strategy is tactical volatility. And what we do is we hold the SVXY. So this is actually the 0.5 times product that I showed you. That's just the one that we trade within this strategy. But we caught the short vol signal, and you can see uninterrupted until yesterday. So it's a very good time to actually show what would happen if we actually shorted volatility with all 7 of these ETFs. And you can see that there's going to be different results. So what I have essentially done is listed them all out. You can see the leverage factors here. And all of these are shorting on a $100,000 allocation, starting market close October 31st, going right up until market close yesterday. And we can start to see a few patterns, and there's a few things that we can learn. Hopefully, as you know, I'm a more conservative person. I don't want you to blow up your account. I want you to be trading for multiple decades, not just a year or two. And so I do like to keep things as safe as possible. So I will say quite a bit about this highlighted red stuff, because this does involve shorting the long ETPs. Remember, those are the ones that we talked about that are on the long side. So shorting. First of all, let me just show you a very quick, less than 60-second clip here on why you perhaps shouldn't short these products. I don't ever short the volatility ETPs directly. First, there's big fees involved because you're borrowing shares to short, and it's not cheap. This is many multiples more expensive than standard trade fees for some of the other option trades, so this is always a major headwind. Second, they're not always available to borrow. You might think you've got a great trade setup that you want to jump in on, but if there's no shares to borrow, then what does it matter? Third, you can have your shares called away on you at any time, so you're not really in control of your own trade. Plus, you should know that the time where they are most likely to get called away on you is when you least want them to be. Probably it's going to be when you're doing damage control on a trade that isn't going well, and you might want a little extra time to fix your trade, but you're not going to be able to because the shares get called away on you. And lastly, and probably the biggest reason here, when you short shares, you have unlimited loss. We're talking about volatility ETFs here. They can spike up hundreds of percent, maybe 1,500, 2,000% if you're talking about the UVXY. Why on earth would anybody trade unlimited loss when one flash crash will wipe out your portfolio? All right, hopefully I made my point there. I personally do not like shorting the long volatility ETPs. Honestly, there's no point. I always think, and I don't mean to belittle anybody, who's watching my live streams. I appreciate all the support and everybody coming, but I do have to voice my opinion. So I always feel that what essentially is happening when people do that, they find a way to talk themselves into these things. I don't really know how they do it, but essentially I think what is happening at the heart of it is they will essentially look at this chart of the VXX, for example. Their brain thinks, okay, I want to short this, and then they literally just go short it, and it's very difficult for them to see past that. They're not actually looking at the myriad of option strategies that you can use that's going to mitigate a lot of the risk. They're not looking at all the risk factors involved in shorting volatility ETPs directly. So I think people just get it into their head, and then they just start grinding through the problem, right? The problem is the massive risk and the fact that you won't be able to sleep at night. But they just, instead of just deviating into something that's maybe safer from the beginning, they find a very difficult time to do that. So what I want to hopefully illustrate is there are better options here. No, that's not the right spreadsheet. Let's go to this one and I'll show you what I'm basically talking about. So if you were to have shorted the VXX with $100,000 starting on the 31st of October, right up until today, you would have made a really nice return, 28.67%. Solid run for the VXX, right? That's what we're looking for. I'm not a day trader. I'm not in and out of positions every 20 minutes. I'm a trend follower, and I'm looking for those medium to long-term trends. And then I have signals, of course, that when the situation is not ideal, I'm going to jump out into safety. We also have positions when the time is right. We can capitalize on market crashes, and we can go long volatility. But the bulk of the strategy is going to be short vol. We're looking for trends, and there's clearly been one in the last 2 months. So 28.67. What if you looked at the exact daily inverse of VXX, which is the -1 times inverse SVIX? That one would have returned 36.67. You can see the 1 times long shorting that one is 28. This one is 36. Well, what's going on there? Well, essentially, there's going to be diminishing returns involved when you short something. You start with a potential return of 100, and it does not matter how low it goes, you can only get to 0, right? So as you go lower and as the trend gets stronger and you're riding this to profit, every day you're getting those diminishing returns. So the only way to really solve that problem would be to do periodic rebalancing. Now, if you did it every day, you sell at market close and you rebalance and you reshort $100,000 in the very same minute, then you would solve the problem completely. But if you rebalanced, I don't know, say every couple of weeks, you could solve a little bit of that problem and the gap would close a little bit. But the SVIX is just so much easier. And of course, you're buying a long product, so there is no diminishing returns there. You're just getting the full bang for your buck, basically. So if you look at the 1.5 times UVXY, shorting that, I think a person would be insane to do that, just because we live in a world where there's potentially going to be cyber attacks and flash crashes. And I just can't for the life of me figure out why somebody would put their account at jeopardy by doing that, especially since we've seen this thing spike up 1,000%, 1,500% already. Even if you shorted just 5 or 10% of your account, remember, you have unlimited loss. So it can go more than 100%. It can go 1,000. You short 10% of your account. Well, all of a sudden, you lost the other 90% of your dividend stocks, your bonds, or whatever else you're holding. You lost the whole thing and you owe the bank money. So I don't think in this, certainly it wasn't a good idea in the past. There was the Black Monday crash and flash crashes, but certainly now in this sort of new age internet time, I would not do that. But there it is, 40% return. 2 times UVIX, everything I just said, just triple it for this UVIX. Don't short the UVIX. Not much more to say there. The VIXM, I suppose you could do it just because it's safer. Remember, that's the M4 to M7, but the volume's going to be low, the share availability and whatnot, probably not the best idea. Now, another thing that you'll notice here is that these 3 columns have 0, and this is the current borrow rate. This is something that people very often don't take into consideration. So for the VXX, for example, you can get a ballpark estimate of the borrow rates just by searching the internet. There's lots of these websites. I'm sure there's 5 or 10 you can find, but the VXX, not overly punishing. You can see a fee of about 3% long term, right? No problem. What about the UVXY? If you want to get into shorting this thing, look at how inconsistent the borrow rates can potentially be for the UVXY. Now, right now, it's charging 11%, but you can see there are times when it's up into the 20s. There are times when the fees can be quite low, quite reasonable, but it's bouncing all over the place. Plus, availability of shares, you can see sometimes it dries up, sometimes you won't get the trades you want. And then, of course, this goes extra for something like UVIX, where the borrow fees on the UVIX, of course, can be pretty insane. Now, the UVIX as a 2 times product, I suspect that there's a lot of, well, maybe not a lot, but some of this 30% borrow rate that we are seeing in the UVIX, sometimes I suspect there might be people maybe gaming the system a little bit. If you, for example, I'm not saying anybody does this, but let's say you held some long shares and you hedged out all of your risk with options, and then you loaned out your shares and you collected that premium, 30%. There are ways that people could potentially do that. Not individuals like me and you, but I would imagine that some institutions have figured out a way to capitalize on the fact that, yes, you could actually hedge out all your risk and just maybe loan out the shares. I don't know if that's happening en masse or anything, but there it is. And then VIXM, 12%, but you got to remember, these are annual. So that's a big punishing hit. Not only are you getting diminishing returns when you're shorting these things, not only are you taking on insane risk, but you're also paying a lot of money to do this. And look, I know a lot of people in the volatility space, a lot of people act like, you're going to make 40, 50% just like clockwork. This is the easiest thing in the world. It's really not. You have to be a very high level professional volatility trader to even be making 15 to 20% long term. That's a world-class rate of return. And when you're taking borrow fees that are maybe half that or maybe more than that, now all of a sudden you're just handcuffing yourself. And the point of this live stream today is there's no reason for that, right? I mean, you could just solve all the problems like that. So let's actually move towards that. Oh, there's one more thing I wanted to highlight that a lot of people ask this question, so I want to do a little side tangent. The difference between SVXY, so this is the minus 0.5 times SVXY. Great return. This is essentially what we made in the last 6 weeks or so in our tactical volatility strategy, because this is the one we use. Remember, risk works both ways. So you might think, oh, it's only 0.5 leverage. Yeah, but drawdowns are also 0.5. And if I could just pull up my old trusty chart that I flash oftentimes, remember, risk hurts more than gains help. So anytime that you can take a 0.5 leveraged ETF, you might think that it's watered down and not very good, but don't forget that anytime you can reduce your drawdowns, you're actually going to have long-term benefits by doing that. So, for example, if you take a 30% loss, you have to make 43% to get back to break even. If you lose 50%, you have to now make 100% return after that just to get back to break even. And when you're shorting volatility ETFs, some of these numbers might seem a little bit crazy when you look at it now, but trust me, in the real world of live trading, these numbers happen. I mean, I've seen plenty of people report online that they're down this much. Look at how much return you need. So if you can right from the start use something that's not going to cost you very large drawdowns, now all of a sudden you're going to be ahead of the game. So that is an important point to keep in mind. But look at compared to ZIVB. Remember, this is the M4 to M7. So we're essentially talking about comparing this one over here with the 0.5 right here. Now, I would say, because a lot of people ask this question, I would say in general, you can consider these interchangeable. They are actually different. They move differently over time, but the actual leverage factor is roughly the same, because this one is a -1, but those further out futures actually do move a little bit slower. You can see the return is quite similar there. And I've actually got, sorry, I've got so many windows open. I've actually got a practical example of this. So our tactical volatility strategy using the 0.5 SVXY is, pretty solid. This is the strategy that we are following. But we can actually, because it is a rules-based mechanical strategy, I can just show what it would be if I just switched out the ZIV instead, right? Just sub out the SVXY and fire in the ZIVB. And you can see it's not quite as good, but roughly speaking, interchangeable, right? This is quite close. There's times when it does better. There's times when it does worse. Now, I would say in general, you can see a couple of patterns here. When the market, the general capital that's out there, the trillions of dollars moving around the markets, when people have a reasonable level of confidence for the medium to long term, that's when the ZIV is going to perform pretty well. So you can see back after the financial crisis, there was really no reason why people were fearing anything. But right around 2016, this was when the 2015 China hard landing scare, people were thinking we're going to get that double dip recession. Certainly up until 2018, people started to get fear. That's when the ZIV is going to start underperforming. And then, of course, after the pandemic, you've got a serious period of underperformance because nobody has any confidence for that medium to long term. So those midterm futures are going to get hit pretty hard. But you can see now, I think confidence is starting to come back to the market a little bit. So this is not a recommendation. This is not something that I'm personally going to switch into. I still use the SVXY, but for the foreseeable future, I think you can consider these two interchangeable. So now I want to actually hammer home the point of why people should just get it into their head that not only are you going to make less money, but you're just so far better off by just don't ever short the volatility ETFs directly. There's no point, and I'll show you exactly why. The first problem with that, of course, it requires regular rebalancing. Now, you can solve that problem just by doing those rebalances. It's annoying, it's extra work, but done. But if you just buy the long or inverse product, you don't have to do any of that. You hold those shares. You don't have to rebalance those shares. Secondly, the borrow fees can be insanely expensive, like I showed you. Well, when you're buying an ETF on the long side, there's no fee. What about the shares not being available? That could cause problems for your strategy, right? If you want to get into something, depending on the timing, you just might not be able to. Well, it's always available to buy the long product, so problem solved. What about the shares getting called away from you? This is something that people often think, oh, it's no big deal. Try to imagine when your shares are going to get called away on you. Is it going to be during stable times like yesterday? You're going to get your shares called away on you on December 22nd when everything's stable and calm and the VIX is in the 13s? No. When you're going to get called away is when you least want to, right? That's what that little clip was talking about. You're going to get blindsided by that, and it's not going to be at a time of your choosing. So I would be very careful managing a strategy in calm periods and then thinking, oh, those shares will always be there for me, no problem. No, you're going to want to do damage control at some point. You're going to get blindsided by something. And when it happens, you're going to realize, oh, you know, that guy ranting on the live stream way back then, he was right. You know, it took a couple years, but I see what he was saying now. Well, you can just solve the whole thing just by buying the inverse products directly. What about the unlimited loss problem? Well, this is a big problem. Like I said, if you're talking about something that can go up 5 times or 10 times or maybe even more in the flash crash, why on earth would anybody do that? I'm not saying it would be a fun day at the office if you were holding, you know, the SVIX and it just blanked because of a cyber attack and you lost 100% of your capital. That wouldn't be a fun day. I'm not pretending that it is. But don't forget that you can only ever lose the money you put into these. So you are solving the problem of losing 1,000% of your money and you're capping it at 100. Now, again, a little bit of a side note here, little side tangent, but you can see that I also offer stock replacement instructions in the VTS community, as well as a full course explaining what that means, examples. But when you're doing stock replacement with long-dated long VXX put options, you're actually reducing your risk even more. And even if the market just completely blanks in a Black Monday type crash, you're only going to lose 30 or 40%. So that's actually even better than holding the ETPs. But ETPs do solve the problem, 100% loss instead of what, 1,000, 1,500. And then the last thing, this is important as well. This is about efficiency. You can't short the volatility ETPs directly in a lot of those account structures where people's capital is. Now, if you have your capital completely outside of your account, this is a non-issue for you. But there are a lot of people who do utilize those tax-deferred accounts. And so, of course, buying long ETFs, they are typically, unless there's some type of regulatory issue there, they're typically allowed as well. So, look, this is just a no-brainer for me. I can't even believe people do this. They try to argue, no, this you can do it. It's going to be safe. It's going to be fine. Why bother? It literally, you've solved every single problem by just buying these ones instead that, oh, by the way, return more money anyway. So what are we talking about here? This is just a complete non-issue. But again, this is not a recommendation. I'm a very safe trader. I have capital to protect. I want to be trading into my 60s, my 70s. And I also have a large community of people who trust me and they follow my signals. And I'm certainly not going to gamble with my own money, so I would never gamble with anybody else's money. But like I said, if it's leverage you want, ... hint, don't do this. But of course, you can leverage up these long products as well. No problem. I mean, depending on how crazy you want to get, go for it. If, for example, 2 times SVXY, 2 times SVIX. Now, you got to remember there's going to be a little bit of borrow rate involved in that because now you're actually going on margin. But borrow rates are actually, you know, whatever interest rates plus a few points here and there. It is something to consider. But like I said, if it's leverage you want, okay, well, there are ways to do that leverage on the long side, solving all the problems of shorting the products. So there's your volatility landscape. You've got 7 ETFs. There's nothing wrong with trading options on VXX, UVXY. We do it all the time in our community. I've got plenty of other side strategies that utilize those. But when you're talking about actually using them in the form of an ETF or an ETP, what are you doing? Come on. You got to move past that. You got to start focusing on the fact that obviously successful investing involves risk management. And you can basically solve half of your risk management battle right from the start by either choosing the right ETFs or by choosing the right option strategy that has a little bit of built-in risk management already, and then you can work on perfecting things and making sure it's all efficient. But don't start with the very worst thing possible and then figure out ways to make it possibly safe. Start with something safe and then work towards making it higher profit. That's always going to be better off. Start from safety and work towards increasing return. This is what I always say. The best way to make the best long-term rate of return is to reduce the drawdowns. By far the most efficient way to do it. You could chase, you could try to make 50% next year, you could do that. But one thing that would definitely solve your problem is don't ever blow up, right? Don't ever take an outsized loss. Don't ever go down 30, 40, 50%, and then you don't have to worry about it, right? So, be smart. There are definitely ways to mitigate that risk. So I see quite a few questions. Hopefully I didn't ramble along too much there. What's the time? You know me. I probably could have cut that by 10 minutes, but hopefully everybody learned a little something in my side tangents. Let's, what did I want to do? I was going to do one other segment, but let's just cut it. Let's just go straight to the Q&A. But first, just a quick 30-second, well, maybe it's 59 seconds, little word from our sponsor of today's live. Hey everybody, so please just allow me 1 minute of your time to introduce my work, and then we'll get right into the live Q&A. So I launched VTS in January 2012 with two main goals. First, to crush the financial industry and help investors start making real progress towards their retirement goals. And secondly, to provide that outperformance at a much lower cost. A low monthly subscription fee scales far better than paying a traditional percentage of assets. Now, our portfolio is currently 5 strategies with low correlation to the stock market and to each other, so it's a completely diversified total portfolio solution. It's also not active day trading, and trust me, anybody from any background can follow in just a few minutes a day. Since retiring from pro golf in 2005, I've been an options and volatility trader for 18 years now, and I share a lot of invaluable volatility data from our dashboard in every daily email to subscribers, so you can learn the same tools responsible for my success. I'm also a certified workaholic, and there's a growing list of courses that all members have full access to. There's a free trial to VTS available to everybody down in the description below or on my website. Come join members from almost 70 countries around the world. I can definitely help you achieve your financial goals. Now let's get into the live Q&A. Okay. Little live stream sponsor there. So quick reminder, I hate doing this, but it really is the best way to get my videos out there. There's quite a few more people watching right now than there are thumbs up. So if you would just take 3 seconds, just hit that button, it would be much appreciated. It's Christmas. That's the gift that I want from you, is help me spread these videos a little bit. And of course, you know, same thing applies. If you are on Twitter, if you do have a large following, that'd be fantastic. Even a modest following, go ahead and forward my stuff. If you feel like somebody else might benefit from hearing me rant about these topics, you know, I have actually saved quite a few people from disaster in the past. A lot of people get themselves into trouble following the wrong people, and I do somewhat pride myself on being the voice of reason in the room. You're never going to see me giving unrealistic expectations and all over Twitter just highlighting all of my wins and hiding all of my losses. I do like to just keep it as realistic as possible, so a thumbs up would be fantastic. All right, let's get into this. There's quite a few. I don't know. I'll try to keep my side tangents to a minimum. Okay, first question. Just a point of note, it would appear that the December VXX crush level current price is quoted as 2027 for the day, only 1763. Not sure if that will affect. I think that's an internal thing. Perhaps there was a typo. Just to put your mind at ease, that crush level dashboard, I'll just fill everybody else in. We've got a little dashboard in our daily emails where I run through all the numbers. Remember I said that these are functioning based on VIX futures and how the products move around in relation to the VIX index, how many days there are to expiration. And I've got a little dashboard here that I updated every day, basically telling people where we are estimating based on today's volatility market, where these products will be in, you know, today, 5-day, 10-day, 21-day. So for options trading, it's great. If you got a 2-week contract, you can get a really good ballpark for what's going on. Possibly what you're saying is there was a mistake in one of these. Just on first glance, these appear correct. So you said the 20th. This is not factored into the volatility dashboard. So that's just an extra dashboard to help people out with their basically strike selection, expiration selection, and whatnot. So it would not have affected anything foundational in the strategies at all. But hey, typos are never good, and I should definitely be more careful. I'm a pretty meticulous person, but clearly I missed something. Did you see SVIX is now protecting its position with calls on VIX, and what do you think about that? How will it affect its performance? So it's unclear just yet. We need a longer period of testing. Essentially, the SVIX, which is basically all of these volatility ETPs, that whole landscape, aside from, potentially using swaps and whatnot, but they're basically only front 2-month VIX futures products. That's it. There's nothing else in the formula. It's just rolling those futures. And the M4 to M7, same thing. It's just those 4-month contracts. But SVIX, interestingly, did add a little hedging component recently. That happened about a month ago. And so there's not enough time to test. It's really going to come down to how large it is, right? Because as I said previously, I really do prefer to be my own risk manager, so I don't want them to touch any of these products. I don't want them to add their own little splash of hedging. I can do that myself. I can design my strategy myself, but I can see where they're coming from. I think what they're going for there is clearly it's going to sacrifice some performance. You can't buy hedges that, 80, 90% of the time they're going to expire worthless. You can't do that without dragging performance down. But I think from their perspective, I think what you're going to see is underperformance compared to what it would be if it didn't have the hedging. And then they're hoping that if there's some type of major event, like a flash crash or something, they're going to be able to advertise that their product is safer. And look, I can see why they're doing it. For me, it's not ideal because I just like to use the products as is. But for the general public, yeah, it's not a bad idea. So we'll see. If it's a tiny, tiny little hedge that doesn't really do anything, maybe it's just little popcorn marketing for them. I don't know. If it's a big hedge, it might be a detriment to the long-term performance. Because typically hedging, you might need it occasionally, but if you stretch it out on a really long-term basis, given the fact that most of them burn and you don't actually need them, it affects long-term performance as well. So SVIX will be a little weaker because of this. The only benefit would be that if there's a big disaster, well, maybe they do a little better. Not for me. Why at all to use the ETPs to short volatility? Why use them at all? Good question for the long products, as I explained. I do see great value in the SVXY, SVIX, very easy to use. Now, like I said, stock replacement is just the same. You could do risk reversals, shorting a put, buying a call, stuff like that, or the other way around if you're trying to short something. You can do things like that with options as well. So point taken, you don't actually have to use the products at all. But I still see value in it. So as you can see, I shouldn't highlight other questions until I'm done with this one. I've got, say, 4 or 5 strategies that use volatility ETPs. I like to spread it around. So some of them I will use just the SVXY. Some of them I'll use just the VXX or the UVXY. Some of them I'll use just options. Some I'll use, you get the point. I think having a large landscape is useful. Okay, back to this one. Yes, thank you very much. To you as well. I've been looking at your numbers. You had a pretty good year as well, so good to see. Hopefully next year is even better. Thank you for the support of the live streams. I know you tune in quite a bit, so appreciate it. Maybe you should start your own. I'll be your first viewer. That's how it starts. It starts with 1. You're talking to dead air. There's nobody listening, but eventually over time, and I've followed your emails and your work, I think people might be interested. So, hey, if you're up for it, give it a shot. How to find correlation between a strategy like Iron Condor with the S&P 500. Like you mentioned, that the Iron Condor strategy is only 5% correlated to the S&P. How do you figure that? Correlation is actually very easy to do. It's just a basic slope calculation in Excel, right? It's just an Excel spreadsheet. So line up the performance of the baseline, the index you're tracking, line up the performance of your strategy or the ETF or whatever you're comparing to. You just do correlation of this to this, and it spits out a number. So as far as getting the value, that's easy. Just a super basic Excel calculation. As far as interpreting the value and then how to use that value within a portfolio, that takes a little more thought, right? Because how do I know that I'm actually looking for a 5% correlation here, right? Our iron condors essentially have no correlation to the stock market at all. I don't know if I can go to my website really quick and actually find the statistics as fast as possible here. I'm hoping that a recent article will have it in here. So yes, here's the iron condor strategy for anybody wondering. It's pretty solid. I've been doing this since, for many, many years, well over a decade now. And you can see the correlation to the S&P 500 at 3%. So why do I do this? Well, one of the reasons it's beneficial for me, and I suspect for pretty much everybody out there, to be honest, is because we have three strategies here that have a higher correlation. Obviously, if we're using 2 times the NASDAQ in good stable markets, SVXY and the SPY, all our safety positions are different, but our aggressive positions are all correlated to the stock market. This one literally is the S&P, and then these other two, of course, they're not perfectly correlated, but they're high enough to say it's a correlation. So until we get kicked out into safety, I've got 60% of my portfolio correlated to stocks. It is beneficial for me to have this one at 0, and it's beneficial for me to have this one negative. So that's why this portfolio works so well long-term, where sometimes, you spin your wheels a little bit on some of these non-correlated, like the last 2 months, for example. It's very difficult to make money if you're not correlated to the stock market when stocks are raging higher. And you can see that that's actually what this article is about, that there is a little bit of a drawdown here. Well, obviously, why would there be a drawdown? Well, we're trading market neutral strategies during this. That's really not great for market neutral, obviously. So interpreting the correlation is more important than the number itself, is what I would say there. But I'm an old school guy, Excel spreadsheets. That's really it for me. Okay, this is a new name. Welcome. I don't know if you've been to the live stream yet. Yeah. Why do celebrities and sports people receive greater fame and recognition compared to individuals in other professions? This is an interesting question. And what contributes to the heightened level of respect people seem to have for them? Boy, that's an interesting question. Why do they? Well, I mean, beyond the fact that their job is quite literally to get eyeballs on them, right? Like if I were to ask somebody, who are the top 200 celebrities? We could start firing off some names. We might argue where they rank in the top 200, but we could make a really good list, right? If I were to say, who are the top 200 lawyers in the world? I don't think I can name one, right? Who are the top 200 professors in the world? I could name a few, and then, of course, everybody's going to be like, oh, woke university professors, so we'll get into an argument there. But you get the point. Their whole job is to get eyeballs on them. So I think that's it. It's just that we as society have just determined that famous people are the best people, right? It's certainly not based on merit. I would say it's just as difficult to be a world-class lawyer as it is to be a world-class Hollywood actor. And in fact, I would say it's more difficult, right? Half of Hollywood, half of them are probably very hard workers, extremely disciplined. They've been doing this for 20 years and they're really grinding. But a pretty good percentage of Hollywood is just people who maybe were born beautiful, who are maybe have, innate charisma. There's something that kind of fast tracks them to where you can't be a world dominating lawyer or doctor without putting in the hours. But it is actually possible to start a podcast based on charisma alone and become famous. It is possible to do that. Now, athletes I would separate because, again, athletes, nobody accidentally becomes a world famous athlete. But yeah, I would agree with you. I think that society in general, if that's what you're doing, more of a philosophical question, I think we give far too much attention to these people, and a good number of them are not going to be too derogatory towards them, but perhaps not worthy of our praise. Let's put it that way. questionable morality, certainly narcissistic, things like that. Whereas I would certainly have more respect if we had a list of the world's top 200 plumbers or electricians. I would rather be friends with a guy who's number 48 electrician in the world rather than number 48, Hollywood celebrity in the world. I think that, yeah, let's go have a few beers with the plumber and regular people. Yes, you're right. We give far too much attention to them. But it's the world that we created, and it's just getting worse. So buckle up. It's going to get a lot worse. From 2018 to November 23, VTS leveraged 7.66, S&P VBINX 6.59. For 6 years, the leveraged portfolio has severely underperformed the non-leveraged. That is completely wrong. No, that's not true. Fix it soon. All right, I'll fix it soon. Yeah, let's fix that. I'm not really sure what you're talking about, but yes. You got to remember too, I like how you included the VBINX because that's actually a better benchmark. The S&P 500 is not a good benchmark because, as you are well aware, it does go through many years of pretty good, solid performance where nothing really eventful happens. And sometimes it can actually be difficult to beat the SPY when the SPY is doing well. I've talked about that a lot, where hard to beat the stock market when stocks are doing well. But what's inevitably going to happen is it's going to have a 30, 40, 50% drawdown. And when that happens, this is not a criticism of you. You're welcome to my live streams, of course. But I would imagine someone like you is not going to come back when it happens and say, oh, by the way, I'm sorry that I said that because turns out the SPY was down 50% and you didn't have any drawdown at all. Oops, my bad. Probably the people that criticize people for underperforming the SPY when the SPY is doing really well, they're never going to circle back and fix that mistake. So I would say that time will tell. Now, I think your numbers are wrong, first of all, but time will tell how wrong you are about that. That the S&P 500 is, I've got dozens of articles and videos laying out a case for why, yeah, sure, 80 to 90% of the time, there's nothing wrong with the stock market. But it's that 10% of the time when stocks are an absolute disaster, that's what you don't want. It's really comes down to, do you care about risk management? If you don't, well, you could just close your eyes, dollar cost average into the S&P 500 and historically make 9%. I would say going forward, maybe less, 7 or 8. Inflation is what, 4.5 in the last, 50 years. So you're talking about a 4 to 5% level of alpha. If that's good enough for you, then that's fine. But for me personally, my portfolio is always designed to do better than that, right? And certainly I don't want any drawdowns that even come close to the S&P when it crashes. Like 56% in the financial crisis, no thanks. 34% in COVID, I had zero. 21% in Q4 2018, I made money. Things like that. I like I said, I would imagine you're not going to circle back and say, oh yeah, good. Nobody's ever complimentary when you actually avoid drawdowns. In this social media age, they tend to only be critical when, stocks are raging higher and you're like, oh, you're not keeping up. Yeah, it can be tough, but, just FYI, our defensive rotation strategy is up 81% this year. So there is that. I think your numbers are a little bit off, but it is what it is. I'm not trying to beat the SPY. I'm trying to destroy the SPY over a 20 to 30 year period. And I think I'm going to do it pretty easily. So stay tuned. Why should someone trade the wheel of fun strategy that I talk about quite a bit? Let's say we trade it with SPY 0.5 or 50% of the wheel consists. Why did I set that thing to disappear? 50% of the wheel consists of selling at the money covered call options. The S&P 500 call right index has a much worse, I like where you're going with this, much worse risk reward ratio than buy and hold S&P. Also, various backtests show that the wheel strategy does underperform S&P buy and hold. Return wise, I like where you're going with this. For VTS, you use a lot of data to outperform the market. So why would it be different here using the wheel strategy and be as simple as selling options? Good. I like it. You're right on all counts. A standard wheel strategy on equities has no expectation of outperforming the S&P 500. Kind of getting back to the previous question, baseline S&P 500, there's actually very few things that beat that if you're just doing blind. Right? You could almost say nothing beats that. I mean, sure, the NASDAQ beats it, but we're talking about just a baseline ETF. SPY's pretty decent as far as the traditional financial industry goes. So if you're doing a wheel, let's say you're doing some type of systematic, I'm going to sell this delta option on the put side, and then if I get assigned, I'm going to sell this delta call option, covered call, and let's say 1 month in advance, right? Just monthly cycles. That's going to underperform the SPY. We already have seen this experiment. So the only way that you can actually do better than that is if you have an edge. Edge can be many things. It could be a risk management edge where you have layers of protection that the SPY does not. You know, you don't want to suffer a 56% drawdown. You don't want to suffer an 86% drawdown like, you know, the Great Depression. So maybe you have risk management edge. Maybe you've got position sizing edge where you're doing some type of scaling system. That might be an edge. Maybe you've got good stop losses in place. You've got good emotional control. You've got, you know, you're jumping in and out based on signals, right? You're only doing it. You're only selling the calls when you get good volatility, implied volatility is high. There are ways to build edge, but that's a whole roundabout way of saying everything you said is correct. And when we do the Wheel of Fun strategy, we're actually using the VXX, remember. So it's inverse of that. I'm using the Wheel of Fun, my wheel strategy, on the VXX with no margin, or on margin with no capital. So the reason that I can do that is because the VXX is inverse the market, right? So if I get into trouble on the VXX, it means that the rest of my portfolio is crushing it. If the market spikes and crashes, that trade is naturally 100% protected. So I actually flip it in reverse. And so doing a wheel like we do in my VIX option strategies, it is actually very beneficial. I think I don't have that spreadsheet open. It'll crash my computer, but I think I do 2 layers. So I have 40%. Basically an overlay with no extra capital, just paying the margin. I think one of them made so far 12% and the other one's at about 6%. So that's pure return and it's 40%. So average of 9, 40% of 9 make about what, 4%? And that's just added on to my portfolio return. If you crunch into a compound interest calculator, how much extra money you'd have if you made an extra 4% for the next 20 to 30 years, I think you'd be shocked at how big that number is. So I do it very conservatively, but yeah, everything you said is absolutely right, that we've seen this experiment before. There are call right strategies. There are those buy right indexes. They're bad, right? There's an iron condor index. It's bad. Anything you do with options on a calendar schedule, there's no edge there. You're basically just 0% return minus trade fees. That's what you're looking at. Options trading actually requires selling things that are overpriced and buying things that are underpriced. And if you're doing something like this, 30 days, this delta, it's a formula, there is no edge whatsoever on that. All right, first time viewer, really appreciate Saturday. Yeah, I was just out running yesterday and I was getting ready to do the live stream, usual Friday. And I was just curious, how many people could show up on Saturday that can't show up on Friday? So I think next year and next week, I'll talk about goals and what to expect from VTS going forward. I'm thinking maybe sort of mid-year, I'm going to start doing 2 live streams. One of them focused on options and one of them focused on the VTS portfolio, because there are some differences there. So maybe in that case, I would do 1 weekday and 1 weekend and then maybe flip them back and forth. You know what I mean? Don't use UVIX, even not for hedging. No, I actually don't hedge my portfolio. This is something that I don't want to get into the weeds too much here. I could talk all day long about why I don't hedge, but essentially each one of my strategies functions as an individual strategy that doesn't require hedging. We essentially, once the market reaches a certain level of volatility, we are out into safety or cash in this strategy. So yes, it's possible that some bad things can happen in this range. And of course, you can get a little bit of a whipsaw. I'm not saying that it's foolproof, but in general, all the bad things in the market happen over here, and we will not be in that. Same thing here. We will be in gold. Now, all bets are off. If I'm in gold and gold crashes as well, then, you know, that sucks. Welcome to 2022. We actually caught the signals very good in 2022. We were out of NASDAQ. We were out of shortfall. We were out of the SPY. Unfortunately, our safety positions also, because 2022 was such a disaster where utilities, real estate, gold, you know, bonds were down 50%. Everything got crushed, so there was no safety. So even though I picked up on the signals and everything worked as intended, that was the first year since I started trading where I was just like everybody else. Like nothing I'm doing is working. It's so frustrating when, you know, at that point, I had 11 years of basically pretty flawless success. And I feel like I had a good year in 2022 navigating around those bad risk periods. But, you know, utilities were worse than the stock market. Real estate was terrible. Bonds were terrible. Bonds was the worst of all of them. So, yeah, it was kind of an eye-opening experience. I don't mean to say I'm happy because, you know, we lost. It was a negative year. It was my first negative year. But, you know, what's that old saying? What's that famous saying? I never lose. I either win or I learn. Well, 2022 was a learning year for sure because I had never seen that happen to my trading before. And I've been doing this since 2005. I've not seen just a perfect storm of all safety positions tanking as well. It was a rough one, but you know, we didn't do worse than the stock market, so there's that. We actually did slightly better, I think, but not much. It was bad. Yeah, I don't hedge because each one of my strategies is designed to cycle out of aggressive positions at the first sign of trouble, and then we move into full safety. Plus, I've got 40% of my portfolio in things that don't require hedging, like Iron Condor strategy. We just use stop losses. It's good enough. The volatility trend is actually broken wing butterflies on VXX, UVXY. The risk is inverted, so there is no risk to the high side there either. It does not require any hedging. So hedging's useless for me. I'm not trying to tell you that you shouldn't hedge. I don't know what your portfolio looks like. It's kind of reckless and irresponsible for me to come on here and say, oh, don't bother hedging. My portfolio doesn't need to be hedged. Yours might. Yours really might. I don't know what it looks like. But are with Charles Schwab now, TD was sold. Do you like Schwab? I've not noticed any difference whatsoever. From my end, I don't even update my platforms either. Like, I've moved away from IB recently, but I even used to use the old IB. It was like 5-year-old version, and I always decline updating it and download all the old versions. I hate when things change, so I've not noticed anything. God, are you the same? You're just doing this because I told you last week not to, right? Thank you so much. I don't want to sound ungrateful. Don't super chat, please. Let me treat you to a coffee. Email me, tell me what city you're in. I travel a lot. Maybe I'll catch up with you and I'll treat you to dinner. But thank you so much, and Merry Christmas to you. Yes, I do drink coffee every day, so I will utilize that money. But in the future, honestly, my live streams are free. You can ask any question you want, and as you've seen, some people ask multiple questions, and I'll read the whole thing. It's fine. I prefer Saturday. I've heard that from several people, so I will try my very, very best. My wife is not sleeping yet. My wife's coming to Dubai 5 days from now, so that'll be cool. 1 month here for her. She only gets a 30-day visa, unfortunately, so yeah, it is what it is. Thanks for sharing. Have a great year. Yeah, you too. Everybody, Merry Christmas. Hopefully everybody had a fantastic trading year. Geometric math for Kegger, not arithmetic. I don't know what that means. Are there more I'm missing? You know, I don't see everything. Oh, this is coming from that. Okay. So you're talking about geometric compared to... I never use arithmetic, of course, for anything. This is one of my pet peeves in the financial industry, that people kind of switch back and forth based on which one serves them best, it seems. I'm not seeing where there's more. Is this it? I know you're very detailed with your work. I can't imagine you overlooked 2018 to November 2023. CAGR facts. Well, I certainly do use geometric if that's what you're getting at here, but unfortunately, I can't really piece this together too much. Yeah, just rest assured. Actually, I had somebody also ask me why I'm using log charts instead of arithmetic charts, and because I switched over a couple years ago, I think. I will always use what best shows the work, right? So log charts, once you stretch it out over a longer period of time, log charts don't make a whole lot of sense when you're looking at short term. Like, so if you've got a 5-year track record or something, it is actually more instructive to just look at an arithmetic chart. But once you pass a certain distance, you don't want those drawdowns to start looking distorted, right? So then you switch over to log charts. Geometric is always going to give more information than, arithmetic's just meaningless, right? That was part of that Dave Ramsey rant video that I made, that he keeps saying over and over again, the S&P 500's made 12% a year in the last 70 years. No, it hasn't. That's only if just add them all up and divide by how many years. Yeah, maybe, but no, it certainly has not. It's a little bit less than 10. So rest assured, I'm using the correct information. Los Angeles. Oh. I used to live in LA, or not LA, California. I lived 2 years in San Francisco. I lived 1 year in Oakland. I lived 1 year in San Jose. Where else did I live? That's about it. Yeah, spent a lot of time in San Diego, spent a lot of time in Los Angeles, but never actually lived there. Back in my pro golf days, I did play a lot of tournaments in California. So since 2005, have not been back, unfortunately. Good luck with that. I only get it on the news, so I don't know if it's totally distorted or not, but it does seem like California, but you never know. Maybe it's all just fake news. What do you think about Gavin Newsom? Is he your guy? Is he going to be able to beat Trump? Right now, the Democrats don't seem to have, I hate being political, but we're an hour in, so I think most people are tuning out at this point. I don't know what the Democrats are doing. Like, are they seriously thinking that Joe Biden can beat Trump? It's not going to happen. Why aren't they trying to substitute out right now? Like, are they going to wait till the last second? I don't understand. All right, great channel. UVXY didn't get crushed on Wednesday's action. Thursday it went up. Why? This is interesting. So you got to remember that there's only... It's not a perfect one-to-one correlation. A lot of people think that the S&P 500 is inversely correlated to UVXY. So one goes up, the other one goes down. This is just always what happens. And it's actually just correlated, but they're totally different underlying indexes. So what ends up happening sometimes is you can get the correlation so it flips for a few days. Remember, I said that these products do not trade based on supply and demand. These products only trade based on what the underlying VIX futures that they are holding are doing. So if those VIX futures go up, even when the S&P 500 goes up, that means the UVXY will go up. That's what happens. So the S&P 500, let's say it has a good week. It had a good week this week, right? But volatility ETPs went the other way. And a lot of people were surprised by that. But these futures are freely traded. People can do whatever they want with these futures. There's nothing saying that just because stocks go up, that these have to continue to go down. They can pause and they can be flat. They can go up. There are also times when the reverse is true. There are times when the S&P 500 is just chopping around sideways, kind of flatlining, but the volatility ETPs are decaying because those futures are dropping. So you really do have to view them as two totally different things. There is a correlation, but they're not related, right? It's the same thing with the VIX. People go ballistic when you see the stock market do something and the VIX doesn't go the same or the inverse direction. It's only 70% correlated. The VIX is based on S&P 500 options. People can do whatever they want in that option market, and sometimes it is inverse the market. So yeah, It is. It is what it is. Sometimes that happens. Plans for Christmas. So Christmas here is tomorrow. Big plans tomorrow. I'm going to edit a video. I'm going to write a script for a new video. I'm going to go to the gym. I'm going to go running. And then I'm going to make a steak because I just bought a new hex-clad, fry pan. So I got a solid Christmas lined up. I'm here by myself right now. I'm in Dubai. I just kind of arrived last week, and I'm just waiting for my wife. So my mom is at my sister's in Canada, so I didn't go back this year. I'm by myself. So work out, cook a nice dinner for myself, my Christmas dinner. JB can't beat JB. Joe Biden can't beat Joe Biden. Have a great holiday. Joe Biden. Oh, Joe Biden. I don't ever get political, but it is kind of a problem when you've got somebody who clearly, like, even if you are a really strong Democratic supporter, that's rough. I'm not an ageist type person. Different people have in different faculties at different ages. There are people who are 60 who you would just say, that guy can't be president. They're losing it. And there are people who are completely sharp at 80 or 90, right? Nobody forced Warren Buffett to step down. Like, the board didn't vote him out when he was 75. Some people are still sharp when they're older, but this man is not. So I don't understand what's going on. All right. In the last 2 weeks, the futures went up while the VIX did not. What does it tell you? Nothing. It just tells me that the volatility hedging and speculation in the VIX futures market decoupled from the S&P 500, right? So you've got several different ways to represent a trade, right? You have to understand that just because the normal person in the market is buying stocks and ETFs doesn't mean that the large institutions are doing the same thing. They've got VIX futures, they've got, index futures, they've got volatility ETPs if they want it. They've got VIX options. They've got a lot of ways, volatility swaps. They've got tons of stuff. It's not a flatline one-to-one correlation. So I know what you're getting at. Like, what does it tell me? I'm trying to read the tea leaves and say, oh, if the VIX does this, but the VXX did that, and this is going to signify that next week there's trouble. It doesn't mean any of that. I know people love to read into it, but it really means nothing. It means nothing. There's nothing to learn from that. You will never know what somebody else's portfolio looks like. You can't possibly know that. So for all we know, the S&P 500 decoupled from the VIX and the VIX futures because a big crash is coming, because everybody's starting to hedge their portfolio because they're terrified of this market event that's coming, and they're already pre-hedging and they're front-running the market. I think that's what you want me to say. But what if their portfolio is so net long the market that they have to hedge, and those are throwaway hedges that they are fully expecting to expire worthless? And actually, they are strong net long the stock market in their bulk portfolio. How do we know that? We don't know whether it decoupled because everybody's hedging out of fear or everybody's hedging out of necessity because they're so net long the market that they're so bullish. Could be bullish, could be bearish, could be neutral. The point is, it tells us nothing. It's the same thing as people digging into the level 2 and, oh, big option block on the VIX options this week, 50,000 contracts. That means VIX traders coming in here to, he knows something that we don't and the market's going to crash. How do you know he doesn't have $500 billion net long the stock market and those are throwaway hedges on the VIX? Nobody knows anything. Unless you're in the room with these institutions, we don't know anything. So try not to interpret things like that. I know where you're going, and it's very tempting. And of course, all throughout the week, I'm on Twitter. I don't post much, but I'm on there, kind of scroll through, do a little drive-by for 5 minutes a day, and I see the same thing. I see discussions about this. Well, wow, the VXX was up on a week that the stock market was up. That means that everybody's scared. That means, well, look out next week. No, it doesn't. It really, really doesn't. So, yeah. But look, that's just one man's opinion. If you want to, if you actually change your market behavior based on reading into those things, I can't tell you you're wrong. Maybe you've got better insight than I do. But I just look at it as those are 3 or 4 completely independent acts. The VIX can decouple from the stock market, happens 30% of the time, right? Imagine a baseball game, World Series. You got two teams, one of them's Vegas odds betting 70%, the other one's 30%. Would it be crazy if the person who was 30% won? Right? I don't ever get political, but it just popped into my head. Do you remember in 2016 when Hillary Clinton and Donald Trump were going head to head, and all the polls had Hillary Clinton winning 70% and Trump winning 30%, which in a political poll, it's kind of a big difference, right? People are surprised that the guy who had a 30% chance to win won. 30% chance to win and he won, and everybody's saying the polls are rigged. Polls aren't rigged. 70-30. You know, the Yankees versus whoever, that, you know, if it's 70-30, don't be surprised if the one that has 30% actually wins. That's not a stretch at all. If it was 99 to 1, that might be a stretch, but 70-30, that's any man's game. Like that, and anybody can win that one. It's the same as the VIX and the underlying futures, the VIX index, the S&P 500. These are 70% correlations. These are not 95, 98. These are, it legitimately happens all the time that the VIX decouples from the stock market. So I wouldn't read anything into it personally. That was a big rant. Trump and Biden are losing their faculties. Yeah, they should just settle it in a big Thunderdome, shouldn't they? Just battle it out. Both of them are kind of beaking back and forth, trying to make it physical. Hey, remember back in the day, way back in the day, they used to do duels? All right, I'm not suggesting that they do that, but throw on some big 12-ounce boxing gloves and see what happens. That might be entertaining. Early Merry Christmas to you two as well. Thank you very much for tuning in to all the streams. Very well explained. I don't know what I explained. Hopefully I hit on something profound at some point today. Do you think that VIX and markets decoupling is the result of zero DTE? Some of it is, right? There's legitimate volume switching over into that garbage. So yeah, I would say the VIX stuff, I would say anybody who's the type of person who's tempted to read into, you know, correlation decoupling, I think has probably had a really rough time the last year, because the VIX, I mean, it's always been pretty worthless. I've been saying this since the beginning, that I don't really use it for much of anything. I use it in combination with other stuff. So for example, the VIX index itself doesn't play any role in my volatility barometer. But of course, when we are in relation to the VX30 contract, that's literally how the volatility ETPs move around, is the value of the constant maturity VIX future between M1 and M2 in relation to the VIX future, or the VIX index, the cash VIX. Because at expiration, you can see it here, 24 days. In 24 days, these two things are going to be exactly the same value. So it is meaningful to know the gap between this and this, right? That's a meaningful measure. So yes, I use the VIX there, for example, but the VIX index itself is pretty garbage. It's like on its own, it's nothing. I don't even think people should look at it, to be honest. Don't overcomplicate the things. The VIX is just one of dozens of random things that you could look at in the market. Really, it's so highly quoted, everybody thinks it's just this brilliant volatility index. It's really not. I shouldn't have highlighted that, sorry. I've got a new series that I'm going to do next year, and I'm going to sort of work my way through it, where I'm going to actually show the basic robustness of these volatility metrics in relation to each other. And we'll have some type of power ranking board where I'm going to show what the best and the worst ones are. And I think people will be surprised how poor the VIX index is. For example, like let's say, this isn't set in stone yet, but let's say you shorted the volatility, the VXX, you shorted the VXX every time the VIX was below its 50th percentile, right? So low volatility is the sign for, you know, shorting volatility, obviously. So I would imagine that you're going to be surprised how poor that performance is. Whereas if you were to measure shorting the VXX when the adjusted M1, M2 VIX futures are above their 50th percentile, higher contango is a better signal. That's going to lead to much better performance than the VIX. So I do want to show that in a quantifiable way. All right. Do you think that VIX and markets decoupling, I read that as if it's the first time I had ever read it. I read it literally a minute ago. Are your barometers, primarily the volatility barometer, based on a weighted average, or do each of the metrics within it have equal weighting? Good question. You're not going to get me to tell you what's in there, but I can tell you that right now, it changes slightly over time, but it's not a good idea to be changing radically what you do. Like something that's working, you can just make little adjustments. So the volatility barometer makes slight changes. Currently, there's 14 metrics inside there, and I'd say 3 or 4 of them are a good 13-ish% each of them. So you could say that of the 13 metrics, 4 of them are half the barometer, and then the other 9 are the other half of the barometer. So I think that answers your question. It's not an equal weight. I do want to get my information from the best 3 or 4 places in the market, and then the other 50% is basically just cross-checks, cross-referencing, just make sure that that one also agrees with all of these signals. But these 3 or 4 are the bulk of it, and then everything else is just agree, that's a green light, right? That's basically how it works. And now you can reverse engineer the whole thing and you can render me useless. Hopefully not. All right, Merry Christmas to everybody. I got to the very bottom. If there's any super last minute questions, next week, I suspect, because I'm going to be talking about goal setting and just what to expect for 2024. So, of course, always feel free to ask me off-topic stuff. I may even get a glass of wine and try to embarrass myself next week's live stream. I remember I was in Panama about, 2-3 years ago? And I did an off-topic, no trading questions at all. You have to ask me embarrassing personal questions or ask me about, digital nomad lifestyle or living on a boat. Maybe we'll do one of those next week. That might be kind of fun. And I can get canceled off social media before 2024 hits. Do you ever consider crypto? Let me delete that stuff. No, I have 2 Bitcoins, still holding them. Bought them, cost basis 24,500, still holding them. I don't know what my plans for those 2 stupid Bitcoins are. Bitcoin's one of those things where I've been critical the whole time. I mean, it's just an absolute, there's no point. There's really no point. I would imagine that the government, they're going to come in and they're going to take control of the crypto market. They're going to, it's 2-pronged approach. They're going to launch their own stuff, and then they're going to actively try to curtail the other stuff. I think that a lot of the crypto world is pretty naive to think that you always hear them say, oh, the government can't do anything. This is independent. Of course they can do stuff. They can do tons of stuff. Just make certain actions illegal, and 90% of the people will follow the law. I mean, yeah, sure, there's going to be some people who go rogue and they try to hide money and avoid taxes and all that stuff. But once you deem something illegal, it actually does have an effect on people's behavior. So all they're going to really have to do, and I think they warmed everybody up to the idea last year and the last 3 years with all these money payments, like these, what did they call them? Stimmy checks, right? All they're going to do is just launch their Fed coin, whatever the Fed coin is, the government coin, and they're going to, and people are going to say they're going to resist it, right? I'm not going to sign up for this government Fed coin. Are you crazy? I'm not going to give them my information. Well, you can't get your stimmy check unless you get it through the Fed coin system. That's all they're going to do. They're going to give some $1,200, make some dumb excuse for another stimulus check, $1,200. And yeah, the hardcore Bitcoin people who are already doing very well financially, they might resist it. But you better believe that 90% of the population is just going to be like, well, what's the harm? I want my $1,200. I'll sign up for the Fed coin system, and that's how they're going to do it. So you can't resist this. I'm throw on the tin foil hat conspiracy theory. I think the government is actively encouraging the crypto world right now. I think that they're using it as data collection. They're actually warming people up to this cryptocurrency idea. They're seeing the behavior. They're seeing how people are using it. They're seeing the psychology around it. They're gathering data. Look, they're getting all this free information. And then when they finally decide to compile everything and strike, it's not that difficult to curtail the other coins. So I'm generally bearish on it, to be honest. I think even though I own 2 Bitcoins, I think that, you know, in general, it's not a bad idea to just, it's one of those things where, what's that old bet? Like if you have a significant probability of, if you have a, you know, 50% chance of tripling your money, but you have a 50% chance of losing all your money, you know, what should you do? If the upside is more than 100% and the downside is only 0, then at that point, you know, you own a couple of Bitcoins. That's essentially why I do it. It's just a basic math bet that the upside to Bitcoin is more than 50,000, right? I own it at about 24.50. The downside is 0. The upside's more than 50,000. You know, I own a couple of Bitcoins, but that doesn't mean that I'm pro on it. I can see many ways that this goes off the rails. So I think it's fascinating, the whole Bitcoin stuff. But I think that these people are completely delusional to think that, oh, they can't do anything. It's untraceable. We can do whatever we want. We can avoid taxes forever. Okay, well, 90% of the world is going to follow the tax laws. So once they say that you can only pay your taxes with, you know, through the Fed system, that's what people are going to do. You're not going to get 50 million people just in unison deciding to avoid, you know, be tax evaders. They're not going to do that. So trouble for the cryptocurrency market. That's a whole long way of saying I own 2 Bitcoins just in case it goes, you know, to the moon, as they say. But no, I'm probably going to lose that 50 grand, to be honest. Maybe not all of it. I'd like to believe that I'll see the writing on the wall and maybe get out at half loss or, you know, 2/3 loss. But hey, you never know. Like I said, if it goes over 50, then it's a good bet, technically. All right. No utility until it's regulated. Well, there's really no utility of Bitcoin anyway, right? I mean, people forget. I could talk for an hour on Bitcoin, but the one thing that people talk about all the time are these basic arguments that, oh, Bitcoin's so fast and bank transfers are so slow and you can't transfer money, you know, over borders. Bitcoin makes it so easy. Yeah. That's a feature, not a bug. The only reason, I mean, the banks in 1980 could have sent money to Moscow in 1 second over electronic transactions. That it's not slow and arduous because the banking system sucks. It's slow and arduous because we don't want to live in a world where you're allowed to anonymously send money to Moscow in 1 second. That's why. It's because of international money laundering. It didn't always be that, but over time, they have these checks and balances to make sure that people, you have to show a passport to send money across borders. You have to, you know, if it's more than $10,000, it's going to flag in systems. You have to be there and sign certain papers. It's going to take a couple of days for the payment to clear. This is all built into the system. And that will also, over time, be built into the crypto system. Now, a lot of people say, oh, no, you can't do that. You can't do. Yes, you can. You can make it illegal to do anything otherwise. And most people are going to follow the law. So again, I think the only upside to Bitcoin is if you convince a large percentage of the world to go rogue and actually be criminals. And I don't think that's very likely. I really don't. I think that most people are the government's going to say, can't do this. It's too dangerous. Money laundering, $10,000. You can't send Bitcoin across borders. And most people are not going to do that. You know, we live in a highly surveilled world these days. It's like, you know, I'm living here in Dubai. I see it's the safest place in the world, right? Absolutely nothing would ever go wrong, at least in the areas where I am. In the UAE, it's one of the safest in the world, but there's crime in the UAE a little bit. But in the city of Dubai, and certainly in the areas that I hang out with, it's effectively zero. There is literally zero crime. You could go out right now, you know, midnight with $2 million watch on your wrist, and there's a 0% chance anything's going to happen. I see no surveillance whatsoever. None. I haven't seen a cop in weeks. Why do people follow the law? Because we know if we get caught doing something, the consequences are severe. Well, the consequences of tax evasion are intentionally severe. I'm going off on a huge rant here. I don't know if people are even interested in this anymore, but if you are, I was just talking about this with my wife recently, that tax evasion is one of those crimes that is extra punishing. So if you were to imagine that you got caught for some normal crime, right? It's going to suck. You go to jail. You know, that's terrible. But what happens with tax evasion, not only do they collect all the money that you should have paid them but didn't, then they give back tax punishment, and they add percentages to it, and it's punishing, right? It might be 2 or 3 times, depending on how long you did it and how egregious your crime was. If it's over, I was checking the Chinese tax evasion laws recently. If it's over 10% of the money that you owed them but you didn't pay, you can get up to 3 years in jail. If it's over 30%, I think it's a minimum of 3 and up to 7 years in jail. Plus, they can take back taxes of anywhere from 50% to 500%. So they can take all the money that you avoided over those years, then they can take 500% extra, and then they can send you to jail. So tax evasion is one of those crimes that it's built into the crime that they are going to claw back everything from you. Whereas some other crimes, you get caught, you know, your life ends, and then when you get out, it starts again. But you don't go back 10 years. But, you know, people don't want to mess around with tax evasion. And if the government just suddenly decides that crypto has to be done through the government channels, it's a wrap. You need, in order for Bitcoin to go to the moon, as they say, you need a large scale people saying no to the government. Good luck with that. I'm not going to do it. Why would you? Why would I? Why would I risk that? Why would I risk my livelihood? So anyway, a lot of people are going to disagree. I know Bitcoin loyals are going to say, no, you can't do that. It's totally untraceable and all this stuff. Okay. We will see. Do you provide reduced rate for your service in the light of the new year? No, unfortunately, no. No discounts ever. For me personally, I see it all the time. Oh, what is it? Black Friday? Is it Black Friday or Black Monday? Black Monday is the market crash. Black Friday is the discount shopping. Okay. Black Friday sales, Christmas sales, New Year's sales. That's not fair to all the people that have been paying me, right? So I don't do any discounts ever. But one thing that I do is when people sign up, that's their price forever. So when I launched back in 2012, January 2012, my price was $50. And I've still got a good percentage of people who are paying $50. And now it's 89. Of course, inflation goes up. I will be raising my prices over time, right? Because my time is not free. I spend, 70 hours a week doing this. I do feel like I should be paid for my work, and the prices go up. But when people sign up, their price never changes no matter what. So you could be there will be people who are with VTS at $50 in 2040 when $50 is, toilet paper. They're going to be paying $50. That's my policy. That's the discount, is that if you support the work for the long term, essentially you're going to go into the future where it's, let's say you have a $500,000 account and you're paying a flat rate subscription fee. That in itself is basically index fund levels of fees, right? That's why I say that flat rate subscription is so much more efficient than paying a percentage of your assets. But then also, what if it's $50, So there you go. I think Twitter just quit. So let's just end this. My stream said it's not efficient enough, and it actually canceled the feed to Twitter. So anybody who's on Twitter, they're not going to hear me say this, but apologies. You're not going to get to hear any more rants. But I think we can call it. I've ranted about Bitcoin. Probably pissed a few of you off who are Bitcoin loyals. Don't forget, I do own 2 Bitcoins, so I'm still on your team, so to speak, even though I'm negative on the crypto. So don't come at me in the comment section. I have an opinion. The government's going to shut that down. The government's going to take control. The Fed is just too powerful. It's one of those things. Please, one more thing. I have to say this. There is a little bit of cognitive dissonance in the crypto world where, on the one hand, people will say, we need crypto because the big bad government is so powerful and so overreaching and so in our lives, and this juggernaut over here. So we need this little thing. Oh, and also this big bad juggernaut that has all the power in the world and the corrupt people, they can't do anything to touch our little party over here. Well, which one is it? Are they either they're the Matrix and they're coming to get you and they're the agent Smiths of the world and they're so powerful, or are they so weak and mean, like useless, that they can't even touch your little party over here? You can't have it both ways. You can't, on the one hand, say that the government is ultra powerful, and on the other hand, they are just completely, powerless. It doesn't work that way. So I lean on the side of, you're talking about the global elites. These people can do whatever they want. If they want to shut down your little crypto game, they're going to find a way to shut down your crypto game. I lean more on this side. The government is something to worry about. The government is something to be against. The matrix, so to speak. Let's use Andrew Tate language. The matrix is against us. We should be resisting that. But to assume that you can just take your chips somewhere else and they can't, come on. It's the matrix. They'll get you. They'll get all of us. So anyway, Merry Christmas. Sorry for the crypto rant there at the end, but come back next week. I promise there'll be more interesting volatility stuff. So Merry Christmas. And yeah, see you next week.